Oil has been one of the most important resources in the global economy for more than a century. It fuels transportation, powers industries, heats homes, and serves as a fundamental raw material for thousands of products, including plastics, fertilizers, chemicals, and pharmaceuticals. Because of its central role in modern civilization, changes in oil prices have profound consequences for governments, businesses, and households around the world. In recent years, oil prices have experienced significant volatility and, at times, dramatic increases. When the price of oil rises sharply, the effects ripple through the entire global economy. Transportation becomes more expensive, inflation rises, production costs increase, and economic growth may slow. Understanding why oil prices are rising requires examining a complex combination of factors, including geopolitics, supply and demand dynamics, financial speculation, energy policy, and long-term structural changes in the global energy system. This essay explores the main reasons behind the increase in oil prices, how high prices could potentially go, and what possible solutions exist to stabilize energy markets and reduce dependence on oil. At the most basic level, oil prices are determined by the balance between supply and demand. When demand increases faster than supply, prices rise. Conversely, when supply exceeds demand, prices fall. Global demand for oil has grown steadily over the past decades. Despite the rise of renewable energy, the world still relies heavily on oil for transportation and industrial activity. Emerging economies such as China, India, and many Southeast Asian countries have experienced rapid economic growth, leading to increased consumption of fuel for cars, airplanes, trucks, and manufacturing. At the same time, global oil supply has faced limitations. Oil production requires large investments, long development timelines, and stable political conditions. Many oil fields around the world are aging, meaning their output naturally declines over time. As a result, maintaining or increasing global production requires constant exploration and development of new reserves. If investment slows or production disruptions occur, supply may fail to keep up with demand. This imbalance is one of the most fundamental drivers behind rising oil prices. Another major factor influencing oil prices is geopolitics. A significant portion of the world's oil reserves is located in regions that have historically experienced political instability, including the Middle East, North Africa, and parts of Eastern Europe. Conflicts, sanctions, or political crises in major oil-producing countries can disrupt production or exports. Even the possibility of disruption can cause prices to rise because markets anticipate potential shortages. For example, wars, sanctions on major exporters, tensions in strategic regions, or instability in countries such as Libya, Iran, Venezuela, or Russia can reduce global supply. When markets fear that millions of barrels per day could disappear from the market, prices may spike quickly. Additionally, transportation routes such as the Strait of Hormuz, one of the most important oil shipping passages in the world, are highly sensitive geopolitical choke points. Any threat to these routes can trigger immediate price increases due to concerns about supply disruptions. The Organization of the Petroleum Exporting Countries, OPEC, along with allied producers such as Russia in the broader OPEC Plus alliance, plays a crucial role in shaping oil prices. These countries collectively control a large portion of global oil production and reserves. OPEC often attempts to stabilize or influence oil prices by adjusting production levels. When prices fall too low, member countries may agree to cut production in order to reduce supply and raise prices. When prices rise too quickly, they may increase production to prevent economic damage. However, these decisions are influenced by complex political and economic considerations. Member countries often have different economic needs, and disagreements about production quotas sometimes occur. In recent years, coordinated production cuts by OPEC Plus have contributed to tighter global supply, helping push prices upward. One of the less visible but increasingly important reasons for rising oil prices is underinvestment in new oil projects. Following periods of low oil prices, many energy companies reduce their investments in exploration and development. At the same time, environmental concerns, climate policies, and pressure from investors have made oil companies more cautious about launching large long-term projects. Because oil projects often take 5 to 10 years to reach production, reduced investment today can lead to supply shortages in the future. This creates a structural problem. Demand remains strong, but new production capacity grows slowly. In addition, financial institutions and investors increasingly prefer to fund renewable energy rather than fossil fuel expansion. While this shift is important for the energy transition, it can also contribute to tighter oil supply in the short and medium term. Oil prices are also influenced by financial markets. Oil is traded globally through futures contracts, which allow investors to buy or sell oil for delivery at a future date. These markets are used by producers and consumers to manage risk, but they also attract speculative investors. Hedge funds, banks, and other financial institutions trade oil contracts based on expectations about future prices. If investors believe that oil supply will tighten or that geopolitical risks will increase, they may buy large volumes of futures contracts. This can push prices higher in the short term. While speculation does not create physical shortages of oil, it can amplify price movements and increase volatility. Another factor affecting oil prices is the global financial environment. Oil is typically priced in US dollars, meaning that changes in currency values can influence oil markets. When the dollar weakens, oil often becomes cheaper for countries using other currencies, which can increase demand. Conversely, when the dollar strengthens, oil becomes more expensive internationally. Inflation also plays a role. Rising costs for labor, equipment, and transportation increase the cost of producing oil. Producers may raise prices to maintain profitability. Predicting future oil prices is extremely difficult because the market depends on many unpredictable factors, including geopolitical events, economic growth, technological innovation, and policy decisions. Historically, oil prices have experienced dramatic swings. In 2008, prices briefly reached nearly $150 per barrel before collapsing during the global financial crisis. During the COVID-19 pandemic in 2020, demand collapsed and prices temporarily fell to extremely low levels. In a scenario of tight supply and strong global demand, prices could potentially exceed $120 or even $150 per barrel again. However, extremely high prices tend to trigger economic slowdowns and encourage alternatives to oil, which eventually bring prices back down. The oil market, therefore, tends to move in cycles. High prices lead to increased investment and reduced demand, while low prices discourage investment and set the stage for future shortages. Economic consequences of high oil prices. First, they increase transportation costs. Airlines, shipping companies, and trucking firms must pay more for fuel, which often leads to higher prices for goods and services. Second, high energy costs contribute to inflation. Because energy is used in almost every sector of the economy, rising oil prices can push up the cost of food, manufacturing, construction, and consumer products. Third, high oil prices can slow economic growth. When households spend more money on fuel and energy, they have less money available for other purchases. However, high prices also benefit oil-producing countries and companies, which receive higher revenues from exports. Possible solutions to stabilize oil prices. Addressing rising oil prices requires both short-term and long-term solutions. Increasing production. One short-term solution is increasing oil production. Countries with spare capacity can produce more oil to stabilize markets and reduce prices. However, expanding production requires investment and may conflict with climate goals. Strategic oil reserves. Many countries maintain strategic petroleum reserves that can be released during supply disruptions. These reserves act as emergency buffers to stabilize markets temporarily. Energy efficiency. Improving energy efficiency can reduce demand for oil. More efficient vehicles, better public transportation, and improved industrial processes can lower fuel consumption. Renewable energy transition. In the long term, the most important solution may be reducing dependence on oil entirely. Renewable energy sources such as solar, wind, and hydroelectric power are becoming increasingly competitive. Electric vehicles also play a major role in reducing oil demand in the transportation sector. Diversification of energy sources. Countries can improve energy security by diversifying their energy mix. This includes nuclear energy, hydrogen, biofuels, and advanced battery technologies. The rise in oil prices is the result of a complex interaction of supply constraints, growing demand, geopolitical tensions, investment trends, and financial market dynamics. While high prices can create economic challenges, they also encourage innovation and accelerate the transition toward alternative energy sources. The future of oil prices will depend on how quickly the world adapts to new energy technologies, how governments manage energy policy, and how geopolitical tensions evolve. Ultimately, reducing reliance on oil may be the most sustainable solution, not only to stabilize energy prices, but also to address climate change and ensure long-term economic stability.